Hey y'all, welcome back to my channel. Today's video, it's going to be a biggie. The market's selling off. Kind of. It was selling off, now it's bouncing. It's confusing. We're going to talk about it. So basically, what I wanted to do in this video is cover what's going on in the markets, what's going on in the world, and how it's going to affect us going forward, and kind of do an update on my thoughts, including things like inflation and the Fed, raising interest rates, all the good things. One thing that I do want to say is people can get political about these things. It's an inflammatory issue, and this video specifically is not meant to be political. It's not meant to go there at all. This is specifically talking about the markets, how we look at the markets, how we approach investing going forward. You might be wondering, Nikki, are you panicking? Are you selling all of your stocks? No, I'm not. Actually, I'm doing the opposite, which is what you're supposed to do when people are fearful. So let's dive into what's going on. This is a chart of the S&P 500. Let me clean up all of my markings. We'll mark these back up so you can see what I'm looking at, what areas I'm watching. The S&P 500 tracks the 500 largest companies by market cap in the United States. It's a diversified index. The NASDAQ is the counterpart, the other popular index, but the NASDAQ holds more growth stocks, and it holds stocks that have higher valuations. It's definitely weighted more towards technology. The S&P 500 I like because it's got some financials, it's got some energy, some big oil in there, which is actually doing pretty darn good right now. So that's why I like to use the S&P 500 as a good proxy to what's going on in the overall market. Now, this is March of 2020. Let me make this a little bit larger. This is March of 2020 where we had the big sell-off because of the pandemic. And we've seen the market be in this roaring bull market, ever since then. So this was the last bear market that we actually saw in the S&P 500, and the NASDAQ sold off as well. Now, we're finally starting to see price action change and shift structure. So what that means, what I do is I look at these candlesticks. This is basically the blueprint of what emotions are going on in the stock market. That's why I love looking at price action. And so what we've noticed recently is price structure has been changing. We've been noticing, instead of buying the dip mentality, every single dip has been bought over and over again, throughout the past few years. And it's been very clear in the price action that there's been a lot of demand for equities. But as of late, we've seen the dips not be bought up so quickly in that, V-bottom price action that we've been used to. V-bottom price action is basically where, you have price sell-off and you have price recover. And that's exactly what ended up happening in March of 2020. This was definitely V-bottom price action. Back here in March of 2020, we saw the market sell off and we saw a very quick, sharp recovery back to the highs. So that's what I mean by V-bottom price action. And we have not been seeing that lately. We've actually been seeing lower highs. We've been seeing big support breaks with putting in new lows. So the actual structure of the market is changing here a bit, in my opinion. We are under the 200-day moving average in both the NASDAQ and the S&P 500 and the Russell. Yeah, see, the Russell's under all the moving averages. The Russell 2000 is going to be your small cap stocks. So we're going into a different environment, and the sentiment of the market is actually showing that. So this is in Ycharts. This is actually the U.S. Inventor Sentiment Index. And this is showing the percentage of people that are bullish on the stock market. And that number is at it reached a 5-year low, essentially. It's kind of picked back up today, but it reached a 5-year low. These have typically been good buying opportunities when sentiment is down significantly and it's very bearish and people are pessimistic about what's going to happen going forward and investing in general. And you guys know the saying, buy when others are fearful, sell when others are greedy. That has proven true. Just look at growth stocks that are down significantly from their highs that were, all the rage in 2020 and in part of 2021. People got greedy and they're now holding the bag, and a lot of those names they're getting slammed in. And so that happens, and now we're on the flip side. We're almost in extreme fear. We're in overcorrecting territory to the downside, where people are so afraid that they're selling their stocks. They think that the market's going to sell off more, which is, possible, of course. But remember, you are looking at a market that's also backed by earnings, backed by, corporations that are actually doing things and providing goods and services. So I've done a video about that before, how you can kind of measure if the overall market is showing value or not. So we're at that time where there's fear, and I typically like to see these environments because they provide good buying opportunities for assets. If you think about the 2008 financial crisis, if you think about March of 2020, the big sell-off, and even before that, sell-offs that have happened before that, with all types of different things that have happened in the markets, they have typically been good buying opportunities, and I'm not seeing this as any differently, but I am seeing some short-term issues that could cause some pain that I will address. I'm not completely oblivious to the short-term effects that we could see from what's going on in the world. So what is going on in the world? Basically, we got news last night that Russia has officially attacked Ukraine, and we're looking at missiles, we're looking at deaths, we're looking at, essentially aggression, and this is not good. The reason for it not being good is not just because it's war, that's never good, but we're seeing this happen on top of us already going through a lot as a society. We are coming out of a 2-year-long pandemic. We have seen inflation running rampant to 40-year highs. We have seen, people have to pay more at the gas pump. People have to pay more at the grocery store. That's affecting how much disposable income that people have to spend in the economy. We've been seeing supply chain issues, which has led to inflation and shortages. And, we've gone through enough. We've gone through enough as a society over the past few years. And this is definitely not helping. But with that said, I do want to point out that we have seen these types of, catastrophes and events in the past in the market. We've seen wars, we've seen attacks, we've seen Black Monday, we've seen financial crisis, we've seen a lot. And this is a pretty good visual. It's going back to the 1900s. This is a guide to the markets slide from JP Morgan. It's oldie but goodie, right? Because it just shows you that, and if this actually goes from 2010 to current, you would see, even more price appreciation in the S&P 500. But the general idea with this image is that we've seen a lot, we've gone through a lot, and the market continues to chug along. We continue to recover from recessions. We continue to recover from wars. And long term, I'm not seeing this issue as any differently. It is definitely not ideal that it's happening on top of us trying to recover from a pandemic. Another good representation of what the market has done and kind of how things have gone down with big events. This is actually some data that StockGeek TV had tweeted out, and StockGeek TV, his name is Travis DeWitt. We're on the podcast We Talk Money together. He taught me everything I know about fundamental investing in stocks. He ran a hedge fund. And so he posted this, and I think that this is a really good just visual of what the different events that we've seen, what they've been, what dates they were, what has the market return been after these big events have happened. Has it been catastrophe to zero, stocks to the floor, or have we seen recoveries? And, we know since all of these events, the market has continued to make all-time highs. We know that the market is much higher. But if you look at just the 12-month returns or the 12-month performance after these major events, you can see that there's more green than there is red. there is red, and there has been some pretty bad 12-month performance after certain types of events. Look in the 70s, we've seen some pretty rough numbers there. And then you can see that obviously Bear Stearns collapsing, 2008 financial crisis, that was pretty terrible. But overall, we've also seen a lot of pretty good performance. And some of these things have been wars, different invasions, different terrorist attacks, the Iraqi war. We've seen a lot of different things, and the market has been resilient. It may have taken time to get back to neutral and to get back to gains, but sometimes it's actually not as bad as the market thinks. What I'm thinking with what's going on now is there is a slight, change here that everything's kind of compiling on top of one another. You have the pandemic, you have the supply chain, you have the inflation, you have the Fed trying to raise interest rates. And then now this happens, right? Now we've got this freaking war that's going on that could affect oil prices, that could affect supply chains even further. And if oil prices continue to stay elevated, oil is a large component of the CPI. The CPI is the measure of inflation. Obviously, oil is going to affect that, and we thought that we were going to be moving into the last part of the year where inflation was going to start to wane, and we were going to start to see that number come in and correct. But now that we're seeing this, and we buy, oil from Russia, we do have reserves. We are working with other countries, all of that, yada, yada. But this is still something that could cause inflation to continue to stay persistent. And in turn, that could cause the Fed to be in a really, really sticky situation. The Fed was expected to raise interest rates all year. They were going to be raising rates all year. And they were going to have, they're trying to deal with inflation. They're trying to cool that down. But I feel like this is all out of the Fed's hands. It's very difficult now for the Fed because if they raise rates too aggressively, too quickly now, with more issues with supply chains, more issues with inflation, more issues with consumers and disposable income and different economies trying to recover, and how those different economies, they travel to the U.S. too. They affect our GDP just as much as we affect their GDP. So there's a lot going on here, and the Fed is in a sticky situation, and it's possible that the Fed will not be raising interest rates as fast as we thought, which in turn kind of goes back to my original thesis that equities could continue to be in demand because guess what? Rates are not going to be high enough to where it's going to beat inflation. Therefore, people are going to need to invest in risk assets to get any return. So the question becomes, after looking at today's price action, we had in the S&P 500, the market broke through a pretty key support level. The support level, give or take, I'll put this line here, give or take. So, this is just a general support level that I have drawn here, and price broke down through that support level today. Actually, it started yesterday, especially after the close of yesterday. We really started to see some selling. And now what we're seeing is a straight up reversal. We literally pulled a red to green. A red to green is when you are red on the day and price is negative, and then it reverses straight back and actually goes positive on the day, meaning the close is above the open. So that's a red to green, and we pulled that hardcore today, and we also pulled that in the NASDAQ. It was the same story. So what's going on here? We're breaking key support levels. We thought the market was going to flush. We're seeing a war overseas. This is going to affect Europe. This is going to affect the reopening of different countries. What gives? So what I'm thinking is maybe the market is thinking that the Fed isn't going to be able to raise rates as fast as expected because of what's going on. They don't want to completely tank the economy. They don't want to completely tank the stock market, right? And it's possible that people are wanting risk assets again because the Fed isn't going to be able to raise rates high enough. Therefore, we're going to have negative yields. Think about negative yields as if you're not earning as much interest on your bonds as inflation is. If inflation is higher than what you're earning on your bonds, then, you're coming out negative. You're not actually beating inflation. And so that's what's happening. And I'm wondering if the market is thinking that that's a reason to buy risk assets, meaning stocks and even growth stocks. We've seen, a pretty big bounce day in a lot of growth stocks that were actually pretty beaten down. So in general, today's price action is kind of opposite of what I was expecting. I was expecting fear, panic, more extreme selling, but we're seeing the opposite. And we're seeing people say, hey, I want to buy equities. I want to buy risk assets in the face of all of this. And the Fed could have something to do with it. Nonetheless, we're still going to have persistent inflation. That's unfortunately going to be with us for a while, I think. And I don't really know how that's going to be handled or what that's going to look like. So let's talk about some possibilities and probabilities in the actual market and some things that I'm doing. I am absolutely seeing this as a buying opportunity. I'm looking to accelerate contributions to my retirement plans. This is actually retirement contribution season, personal IRAs, solo 401ks, pension plans, SEP IRAs, all of these different types of accounts that you can invest in and save on taxes. If you don't know about this, you need to check out my Wealth Master Plan training program. I teach all about it. But it's retirement contribution season, so I am absolutely looking at accelerating contributions into my retirement accounts to take advantage of this sell-off. We don't know where this is going to go. We don't know how low this is going to go. Let's take a look at some possibilities. So one thing that I like doing, I do use technical analysis. I like to look at just general levels, like I had this level pulled here, this support level here. And then I say, okay, well, what's the next major support level that I see? And there's, really nothing too major until maybe these levels around 4,100 and 4,000, just round up, just call it. So these are the shorter term levels that I'm watching. If we can see price hold 4,100 like it did today, this is where I'm going to be watching price action closely to see if I'm expecting more lows or not. Now, I like to pull Fibonacci retracements to just kind of see if I can find some confluence amongst different areas. And when you pull the retracement, the next major retracement level is around 3,800. Do I think 3,800 is possible? Well, let's go back to basics here. If, let's say, the market got to this 38% retracement level, which is actually the 3,800 level on the S&P 500. I'm rounding up a little bit there. Earnings estimates I've seen anything from 225 to 230. The most recent earnings estimate that I saw from FactSet was 230. So let's round that down because of all of the geopolitical issues, and let's say the economy doesn't do as well and corporations suffer a little bit, and let's say earnings are 220 a share. So what I would do is I would take the 3,800 price target in the S&P 500. A lot of people think it could go even lower than that, but this is how I kind of justify if that's possible or not. And then I divide it by the earnings estimate of 220, which I'm rounding down a little bit here. I could probably round down even more to be conservative. And that puts me at a 17 times PE, price to earnings ratio. It's a little over 17 times price to earnings. So 17 times price to earnings ratio is actually under the 5-year average. It's a little over the 10-year average. But that would be something that I could foresee as a possibility. So could I see the market pull back more and, retest a level as low as 3,800 getting below that 4,000 price, yeah, I can see that happening. I think that that's a reasonable possibility. Now, when people say that we're going back to March 2020 levels of, 2,500 or 3,000, that's when I start to say, all right, y'all, something really, 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 really freaking bad is going to have to happen, I think, for those levels to be reached, because that would just be a fire sale in equities, in my opinion. So I don't see that as a likely possibility. This 3,800 level would actually be a nice, healthy extension. I think that would be pretty healthy to see in this market. So possibility, but who knows? We could end up also seeing price just bounce off of this level and retest all-time highs too. So you never know with these markets what they're going to do. But this is why I pay attention to the price action, every single day as a new candlestick comes in and a new level gets tested. I'm kind of taking that as an input and I'm reassessing where I think the market can go. Like right now, I've been sitting on my hands. I haven't been making a lot of moves in the market. I took some trades, entered some positions, like starter positions in some things like DocuSign. I think I added to Square. And so there are a few things that I did do and I was early on. But I haven't been making massive moves and a lot of things have been just kind of waiting to see what this market is going to do, because I like to wait for confirmation sometimes when we get into these types of environments. So that's what I'm doing. And the NASDAQ is obviously looking, it had a deeper sell-off. It has more volatility just by the nature of the companies that are in the NASDAQ. It's going to have more volatility. So if you don't like volatility and you don't like growth stocks, you might want to look more at the S&P 500 because it's a bit more diversified, like I mentioned earlier. But it's the same general principle here, the same general idea. We could definitely see the NASDAQ head a little lower and retest below 13,000, retest a level below 13,000, and kind of finish that extension of that move that to the downside that it's had. So we're going to have to wait and see what price action does, if this is just a relief rally that we're seeing, or if this is a significant reversal and bounce that is going to continue for the future. So am I panicking? No. Am I going to be purchasing more ETFs and more individual stocks? Yes. Buying when it doesn't feel good is usually a good time to buy. Obviously, you want to be buying quality. You don't want to be buying junk like Nikola or, Dogecoin or anything like that. But this is the time, if you are trying to learn how to get invested, this is the time to do it. I see so many people that when the market is down, they want nothing to do with it. They don't want to learn anything about it, and they just walk away. That's the complete opposite of what you should be doing. So keep that in mind. All right, everyone. I hope you found this a little helpful, grabbed something from it to help you stay a little calmer and a little more calculated going into wherever we're heading from here. Let me know in the comments below what you found helpful from this video. That always helps me when I'm going to create more content. Like this video, subscribe to my channel if you're not subscribed. If you want market insights and finance content, learn how to manage that money better, make sure to check out wetalkmoney.com. I'm a co-host of that podcast. It's good stuff. It's a lot of content like this on the podcast. And also if you're new to investing and you want to learn more, I'll link up my Wealth Master Plan training program. That is where you can get started and get on the right foot with your money. So I'll see you in the next video.